If you freelanced last year and didn't pay quarterly taxes, there's a reasonable chance you owe the IRS somewhere around $3,800 right now. Not because you did anything wrong, not because you were hiding money, just because nobody explained the rules. The IRS collects taxes 4 times a year from freelancers. Most people don't find this out until the 5th time, when they file their annual return and see a number they weren't expecting. By the end of this video, you'll know exactly how quarterly taxes work, how much you're supposed to send, when to send it, and, this is the part most creators skip, why the conventional advice about this is actually making you worse off. We'll get to that. But first, let's start with why this exists at all. When you work a staff job, your employer withholds taxes from every paycheck. You never touch that money. It goes straight to the IRS before it hits your account. When you freelance, there's no employer doing that math for you. Your client pays you $4,000. You get $4,000. It feels clean. It feels like profit. It is not entirely profit. A portion of that, roughly 36% if you're in the 22% federal bracket, and we'll show you how that number works in a moment, was never really yours to spend. The IRS knows this. They expect you to send that portion to them throughout the year. Not all at once in April, throughout the year. That's what estimated quarterly taxes are. They're a payment system designed to approximate what an employer would have withheld for you, spread across 4 due dates. Miss them, and the IRS charges an underpayment penalty. It's not enormous, but it's not zero. And more importantly, missing them means the tax bill you get in April is one you've had no time to prepare for. But here's what nobody tells you clearly enough about that bill. Most conversations about freelance taxes focus on income tax. That's the rate most people mean when they say, my tax bracket. But there's a second tax, one that's less visible and costs you more in the early to mid-income range. It's called self-employment tax. And if you're not accounting for it, your quarterly estimates are probably too low. Here's the math. When you work a staff job, Social Security and Medicare taxes get split between you and your employer, 7.65% each. When you freelance, you are the employer. You pay both halves. On $60,000 of net freelance income, that's roughly $8,478 in self-employment tax before federal income tax even enters the picture. The 22% federal bracket gets a lot of attention. This number, $8,478, gets almost none. That's the thing most quarterly tax videos don't show you clearly. And it's why the rule of thumb you've probably heard, set aside 25% of every invoice, is likely not enough. 25% gets you close. But depending on your deductions, your state tax, and your income trajectory, close isn't always enough. The number we'd actually use? 30%, as a floor, not a ceiling. We'll come back to what to do with that number, but first, the timeline question everyone gets confused about. Quarterly taxes are due 4 times a year. The dates are not evenly spaced. That's the first thing people get wrong. April to June is 2 months. June to September is 3. September to January is 4. The IRS calls them quarters. They are not equal quarters. Don't let the name fool you. The income that each payment covers is the income you received during that period. Now, how much do you actually send? There are 2 methods, both illegal. One is smarter for most freelancers. Method 2 is called the safe harbor rule. If you pay at least 100% of what you owed last year, spread evenly across the 4 deadlines, the IRS will not charge you an underpayment penalty, even if your income went up significantly. For freelancers with variable income, which is most freelancers, this is almost always the smarter method. You might owe a lump sum in April, but it will be predictable. It won't come with a penalty attached. One note. If your income last year was over $150,000, the safe harbor threshold rises to 110% of last year's bill. That's a real number worth knowing. Now, where do you actually send this money? The IRS payment portal is called Direct Pay. It's at irs.gov. It's free. You select Estimated Tax, enter your information, link your bank account, and send the payment. No account required. No login to create. Save the confirmation number, screenshot it. Put it in a folder labeled Taxes somewhere you'll find it. You can also pay by check, mailed to the IRS with Form 140 ES attached. But direct pay is faster, trackable, and doesn't involve a stamp. If your state has income tax, you may owe quarterly payments there too. The process is similar. Most state revenue departments have their own payment portals. That's a separate step that depends on where you live. All right, you know what quarterly taxes are, why they exist, how to calculate a safe estimate, and how to pay. But here's where most freelancers make a quieter mistake, one that doesn't show up until later. The math of quarterly taxes isn't hard. The behavior is. The problem isn't knowing that you owe 30%. The problem is that the 30% is sitting in your checking account next to your rent money for 3 months. Invoices are irregular. Some months you earn $8,000. Some months you earn $1,200. In a slow month, the tax reserve looks like a cushion. Behavioral economics has a name for this. It's called mental accounting failure. Money that's earmarked in your head doesn't stay earmarked when it's in the same account as everything else. The single most effective thing a freelancer can do, not the most sophisticated, just the most effective, is open a separate savings account and move 30% of every client payment into it the day it arrives. Not at the end of the quarter, the day it arrives. That account isn't an emergency fund. It isn't accessible. It has one purpose. When the quarterly deadline comes, you know exactly what's there. You pay from it. You don't have to think. This sounds obvious. It's also not what most freelancers do, because no one explicitly tells them to treat tax money as already spent. It isn't your money. It was never fully your money. The sooner that distinction becomes automatic, the less stressful April becomes. Let's put this into a system, something that takes less than 20 minutes per quarter. Step 1. Find your prior year tax bill. Look at your last Form 1040, line 24, total tax. That's your baseline. Step 2. Divide by 4. That's your safe harbor payment per quarter. Step 3. Pay by the deadline. IRS Direct Pay. Done in 5 minutes. Step 4. Set aside 30% of every future payment. Separate account. Automatic, every time a deposit lands. Step 5. At year end, compare your actual earnings to your estimates. If you earned significantly more than last year, you may want to top up your final Q4 payment, or just plan for a balance due in April with no penalty attached. That's it. That's the whole system. The goal isn't to owe nothing in April. The goal is to owe a predictable amount, one you planned for, one you have the money for, and one that didn't cost you a penalty to arrive at. Quarterly taxes aren't complicated. They're just never explained in terms of what they actually cost you if you ignore them, or how close the standard advice cuts it. 30%. Separate account. 4 deadlines. Safe harbor. Those 4 things will handle most of this. If you want to run your own numbers, including the self-employment tax calculation, we've built a simple spreadsheet that does the math for you. It's free. Link is in the description. Plug in your prior year tax bill, your projected income this year, and it tells you exactly what to set aside per invoice and what to send each quarter. And if you want this kind of analysis, without the anxiety and without the jargon, every week,